So we recently sent out an email to all of our investors with a quick update regarding the COVID situation, highlighting some of the different asset classes and how we viewed each asset class kind of overcoming this particular challenge. And each asset class does have its own unique challenges regarding this particular virus. So I wanted to send this audio version out to you in this brief Monday Minutes, because I know some of you are not on our mailing list, which is completely reprehensible. So if you're not on our mailing list, go to cashflowconnections.com and sign up, or you can go to asymcapital.com. If you don't already have access to our investment opportunities, you're missing out. There's likely going to be a lot of opportunities in the wake of this challenge. So here is the quick high-level overview. Now, as concerns surrounding coronavirus continue to increase, people are rightfully searching for accurate information, both about the global economic impact of the virus, as well as their own physical and economic well-being. This short little Monday Minutes is meant to serve as a quick update around what we're currently seeing in the real estate space and how we anticipate the major asset classes that we're focusing on will be performing in the coming weeks and months. Of course, the most pressing concern is our health. If those concerns can be addressed, the safety of our investment capital is the priority. While every economic and geopolitical shift has its own unique risks, this particular pandemic has drastically altered the Overton window in terms of potential economic outcomes. The most noteworthy and the first of its kind in history is the significant difference between a revenue reduction that is typical of a recession and a complete fall off of income that was created not by a decrease in demand, but by mandatory shutdowns and shelter-in-place orders. Given this economic reality, discussions about the likelihood of a recession have turned to an even greater question. Will this downturn result in a recession or a depression? As such, federal and state governments have taken unprecedented action to stimulate the economy in an effort to soften the blow that a lot of people are predicting is coming. In the world of real estate, we've seen transaction volume essentially come to a halt. Now, it is true that some lenders are willing to lend in this environment, but it's important as syndicators to be committed to securing a great deal for our investors. So before investing, we want to ensure that we have a clear path to value creation, cash flow during the hold period, and the ability to purchase an asset at a discount to market. Because of the low transaction volume, though, it's very difficult to establish a market price right now. Furthermore, real estate is traded on a multiple of income. And if that income is no longer reliable, the typical income formulas are no longer a reliable method of price discovery. Every industry and every market is going to be impacted by this pandemic, whether it's a small ripple effect or a huge tidal wave. At Asym Capital, we're dedicated to having a holistic view of the real estate market, which includes understanding several asset classes within the sector, each of which will likely be impacted differently by this virus. Many of the concepts in this article have been discussed at length with economists, investors, and sponsors on our program, the Cashflow Connections Real Estate Program, which you are listening to now. And a lot of those conversations impacted my worldview when it comes to the different asset classes and the risks associated with each. So let's start with multifamily apartments. For the last decade, apartment buildings have experienced an exceptional run, both in terms of net operating income and cap rate compression, and for good reason. As we've seen an increasing number of young people either opt to rent or be unable to purchase a home, the multifamily investment thesis has become more and more compelling. This is especially true of workforce and affordable housing, which cater to households receiving close or below median area income. This is a solid thesis and it has a proven track record, but this market is now facing a significant challenge. The shutdown puts a major strain on this tenant demographic because many of the tenants don't have additional funds to pull from in the event that they lose their jobs. The government understands this challenge and has taken unprecedented action to mitigate the damage done to this significant segment of the economy. In March of 2020, the Coronavirus Aid, Relief, and Economic Security Act, which is known as the CARES Act, allocated more than $2 trillion to those who have been negatively impacted by COVID-19. More specifically, it was allocated to those who've lost their jobs or are struggling with medical hardships as a result of the disease. Then, on April 9th of 2020, the Federal Reserve announced another round of initiatives to bolster the U.S. economy, which includes an additional $2.3 trillion program focused on providing significant liquidity to the market and the economy. In an attempt to avoid a 2008-like liquidity crunch, many lenders have created debt forbearance programs so that property owners can provide more flexibility to their tenants. When tenants cannot pay, property owners cannot pay, therefore banks are forced to foreclose. However, we're confident that this government action and the availability of these programs will provide enough liquidity to the necessary institutions so this concern is mitigated. Despite the actions that the Fed has taken, we anticipate that we'll still feel downward pressure on rental income collections through at least May and June as tenants make their first full payments post-COVID-19. Right now, the goal for most owner-operators is to keep tenants in place. We've seen an increase in concessions to ensure that assets don't experience a drop in occupancy, and we want to ensure that we retain tenants through the next few months. If occupancies remain high, once the shelter-in-place orders begin to lift on a state-by-state basis, we anticipate that the upward trajectory of multifamily will continue based on the favorable supply-demand position of affordable housing. All right, let's talk about self-storage. Self-storage is one of our preferred commercial real estate asset classes, has been for quite some time. This asset class has understandably suffered the least price devaluation in the public markets. We have conversed with several sponsors who cumulatively own nearly $1 billion of self-storage, and they have all reported normal or even increased property-level activity over the last few weeks. Now, demand for self-storage is primarily created by individuals moving residences, and the dates of those moves are typically predetermined and based on 6 to 12-month leases. As a result, a lot of these move-in, move-out dates have not been postponed or otherwise altered. Furthermore, many universities have shut down early, which has created an early surge in demand that was originally slated for, let's say, May or June. In short, self-storage tenants typically visit their self-storage units twice, once to move in and once to move out. By and large, the negative impact of the shelter-in-place orders has been sidestepped in this area, as well as the concerns about on-site contamination because people aren't really supposed to be spending much time at the property. Okay, let's discuss the mobile home park business. The big picture thesis of the mobile home park business includes both an investor-favorable supply-demand disequilibrium along with a recession-resistant component. Together, these create the tailwinds for an asset class that should help cushion the concerns surrounding the long-term economic blowback associated with COVID-19. However, tenants who earn hourly wages will likely take a significant hit in the short term as their employers are forced to close. Local, state, and federal governments are well aware of the burden that seizures of the job market will put on those who are in low and middle incomes and have quickly pivoted to limit the damage as much as possible. Many of the recent government programs addressed in the multifamily apartments section are also geared towards the tenants of the mobile home park business. Most notably, the forthcoming $1,200 check issued per adult could create up to 3 months of rent in many mobile homes across the United States. In 2 adult households, another potential $1,200 check will be cut, equating to up to 6 months of rent in many markets. So this is really important data if you're contemplating how this is going to play out. When it comes to senior living, the risk to the sector is quite unique in that it's not as focused on NOI. Many of the tenants are paying rent from a combination of savings or Social Security or immediate family members, many of whom likely hold jobs that can be completed from home during this time. The challenge here is that the sector's tenants are at a much higher risk, given this particular virus is most dangerous to the elderly and immunocompromised. Of course, this is the general makeup of most senior living communities. As such, many owner-operators are not anticipating significant reduction in income, but are more concerned about contagion, the health of their tenants, and the ability to lease up vacancies amid shelter-in-place orders. That said, the investor demand for this asset class has seen strong growth over the last few years. This is a result of many factors, including the fact that there's been an extremely significant demographic shift taking place as senior citizens occupy a larger and larger percent of the overall population. In fact, it's reached all-time highs. According to a recent report by Marcus and Millichap, more than $1.3 billion in transactions took place in the senior living sector in February of 2020, which is up about 18% from the same month last year. Once this uncertainty subsides regarding coronavirus, I certainly anticipate that this upward trend will continue. Now, in terms of the government action, more than $600 billion in grants and loans are available specifically to the senior living sector as part of the most recent stimulus package. along with all the benefits associated with the Paycheck Protection Program, PPP, one all businesses with fewer than 500 workers can apply for. Many of these funds will be used to help the sector and ensure that it thrives through the crisis. Additionally, experienced owner-operators are already well prepared with the resources and the protocols to deal with property-level contagion, given that the sector that they work within is focused on that particular risk. This is very common to contemplate that risk in the senior living sector. Okay, let's talk about retail. Retail shopping centers, particularly those that are not anchored by grocery stores, are facing a really serious uphill battle within this particular crisis. A lot of business out there are prepared for let's say 25 or 33% reduction in revenues due to an unforeseeable recession or some other property-specific risk. But before COVID-19, it would be very challenging to envision a thesis that would result in a 100% collapse of all in-store revenues. Because of this, a high percentage of retail tenants are requesting debt assistance, forbearance, and forgiveness. One important thing to note, though, is the distinction between a typical recession due to a business cycle turnover versus a mandated shutdown. Many of these businesses are not struggling due to a decrease in demand or even a business model that isn't profitable, but a hyper-specific issue, one that will certainly be resolved. Lending institutions and property owners understand this and will likely show quick flexibility to their quality tenants. The federal government's actions have provided them the flexibility to do so, and this is exactly why. Where there's uncertainty, there is almost always an opportunity to purchase distressed assets at a significant discount. We're going to continue to monitor the situation with any new developments in the sector, as we have been for the past several years, and hopefully there'll be an opportunity on the other side of this particular risk. Okay, let's talk about distressed debt. It's something that we haven't talked a lot about on this program. Now, out of all the asset classes that are likely going to present a clear opportunity in the wake of COVID-19, I'm anticipating that the distressed debt space will reveal potentially the most viable prospects for pricing arbitrage. When jobless claims are consistently reaching all-time highs, defaults on debt obligations are certain to follow. The main concern that I have about this particular space is the regulatory hurdles associated with debt collection, especially following a pandemic. Recent events imply that the federal government may be quick to enact sweeping laws that could create a moratorium on standard collection practices, or even inspire borrowers to stop making payments and use COVID-19 as a way to justify their actions. Regulatory risk is always a concern in this space, but is especially pronounced during this crisis. While we have not really significantly participated in this sector of real estate, we have been reviewing opportunities with a variety of operators for quite some time. I'm pretty confident that over the next 90 to 180 days, it's likely that we'll have an opportunity in this space for a variety of reasons, most notably the opportunity for pricing arbitrage given the uncertainty in the sector. Following the data. It can be very challenging to follow accurate data with so many opposing narratives available to us in the information age. One resource that I've been tracking closely is JP Morgan's coronavirus research compilation, particularly the infection tracking charts, which are updated daily. We'll link to those in the show notes page. Hopefully, we'll see these numbers begin to turn around in the following days and weeks, and then we'll be able to create and see in real time a clear pathway to a new normal. Another data set that I'm focusing on is state-specific information and how each state's reaction to COVID-19 will impact its contagion rate. While it is very early, it does look like New York, the US's epicenter of the pandemic, is showing some promising signs in terms of leveling off the number of new cases. Thriving during a crisis. Listen, if you're familiar with this program, you've probably heard some of these concepts before, but it really can't be overstated right now. The economic and health-related pressure surrounding COVID-19 is strong enough to create tertiary challenges in all of our lives. This is particularly the case when it comes to anxiety, stress, and even a bit of stir craziness. However, there are a few steps we can take to ensure that we're doing our best, not only to remain optimistic, but to truly thrive through the crisis. Physical exercise is paramount to mental health, especially while remaining at home for the majority of the day. Additionally, meditation and visualization have proven to have lasting positive impacts on mood, cognitive ability, and yes, even physical strength. And we will link to all those resources that I highlight there to kind of back up that claim in the show notes page. As with all investors, I look at things on a risk-adjusted basis. In my opinion, there are very few more favorable risk-return ratios than taking 10 minutes to sit in silence, especially if done with the help of a meditation app like Headspace or Calm. So thank you very much for taking a quick listen to this Monday Minutes. I hope you continue to monitor the situation closely, because if you have a thorough grasp on how the situation changes, it's going to empower you to capitalize on what is almost guaranteed to come from an investment perspective. So I will keep giving you the info, keep chugging along. Thanks, guys. Really appreciate it. In the meantime, just stay safe. All right, listeners, you know the routine. This show is all about learning, making wise investments, and protecting and growing your capital. So if you're interested in these topics, make sure to hit the subscribe button. Of course, if you've already enjoyed a couple of great episodes, don't be shy. Leave a review. It really helps the show's visibility. And lastly, if you're an accredited investor and you're interested in learning more about our investment opportunities, the types of deals that I personally invest in, go to asymcapital.com. That's ASYM capital.com. Thanks a lot.